Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey, Ross, I'm doing well and great to speak with you as always.
Yeah, great to talk to you as well, and I'll be really excited to hear some of your insights about this strange market we're in right now. We've had a bit of a rally off of the lows, but I wanted to talk to you about this concept of bear market rallies, which is kind of head fake rallies in the midst of longer bear markets. 2018, 2020 sell-offs, were really V-shaped at the bottom, but that's not that typical. So could you talk to me a little bit about what you're seeing in the market and what you're thinking about bear market rallies at this point in time?
Definitely. Just to give it some context, our price trends are negative on the S&P and for a lot of the sister indices out there. I know we haven't hit 20% on the S&P 500 on a closing basis, but when you look at a lot of the underlying constituents, they're down sharply from their highs over the last year or so. And so we wanted to keep in mind that it's not going to be straightforward here, as you mentioned, the V-bottoms. And historically, bear market rallies on average are about 15% over 34 trading days. As you mentioned, we hit, call it 8-9% in the last week or so. So I think we're still short on the duration and length, but I also want to be very careful not to get sucked in and to believe that a rally here is the end of the bear market, right? We need to see overwhelming breadth skews. We need to see a sharp expansion in the amount of stocks hitting a new high coming off of low. And the ingredients there on these recent bounce, and even the bounce back in March, the 11% rally there, did not happen, right? We got one or two of items on our checklist checked off, but the full picture, like we saw back in March 2020, is just not there. And so we're more inclined to view this along that average 15% over 34 trading days, treating this as a bear market rally. I'd also mention that for the NASDAQ, a lot of the beaten down growth names, a bear market rally for the NASDAQ 100 historically averages about 40% or so. We saw back in the tech bubble 3 rallies of around 30 to 50%. So bear market rallies can be very difficult to navigate, and they can be very sharp head fakes. So I think if you're playing this tactically, keep the leash very tight over the coming weeks and months for the summer.
Yeah, absolutely. Those bear market rallies can be so enticing, but it pays to remember that often a bear market is a process that takes some time. Something else that you do in your work a lot is look at flows into and out of certain asset classes and sectors. And you noted recently that there was a huge influx of capital into Treasuries, U.S. Treasuries. And I wanted to get your thoughts on that amid this kind of defensive market environment.
Yeah, what's curious is you have this equity market under pressure. And so now you're seeing defensive sectors like utilities, healthcare, and staples pick up inflows. But you're also getting an absolute swell of flows into Treasury products. So I think one is defensive there, right? One aspect of that. But I think the second aspect is this buy the dip mentality that is in bonds right now. We know bonds are in a very sharp drawdown. But when you look at the amount of money that went into Treasuries, even in May alone, 18 billion, that was the top of our category workbook, and almost 50 billion year to date into Treasuries. Investors, whether they're institutional or retail, they're looking to buy the dip in bonds. And I think that's a bit of a consensus play here, and the expectations that yields are going to come in. Well, the flows, which suggests the opposite's going to happen, and you look at what's going on in Europe too right now, where yields are hitting new highs. And so it's just amazing to us that buy the dip was the idea for tech the last decade. Now it seems to be in Treasuries, and we just think that the sentiment picture there is very offsides for bonds until perhaps that starts to cool off in the future.
Yeah, and you mentioned news cycle highs for yields in a lot of places across the world, and you all have done some work that says that cycle highs and yields are not necessarily consistent with peak inflation, which is the narrative that you kind of hear if you go out into the markets. Another thing that's not consistent with that is the strength from the energy sector this year and in the last couple of weeks. I know a lot of investors would be hesitant to kind of dip their toes into that sector at this point, given the outperformance, but still acting like leadership, right?
Totally. And our tagline for energy right now is overbought but not overowned. Overbought is energy is historically overbought right now. You are 40% above your 202 moving average. That's the highest since the late 70s, early 1980s. So in the short term, I wouldn't be surprised to see energy pause here. I think that's reasonable. The sector's up some 60% year to date. But it's leadership right now. It was leadership going into this correction. We expect it to be leadership going out of this correction. So we want to use any sort of weakness to continue to add exposure. And the idea being not overowned is that it's only 5% of the S&P. That's up from 2% in March 2020. Historically, the average for energy in the S&P is about 11%. So you could split the difference there to about 8 or 9%. And I just think it's tough to be overowned when you're such a small segment of the S&P. And so we would not call energy consensus right now in many of our client conversations. I think it's interesting that the flow data, you actually had outflows from energy last month. So a little skittish sentiment from investors. And I think a lot of folks are just scared how overbought the sector is right now. But again, don't fear overbought conditions. You want to use any sort of mean reverting pullbacks to continue to add exposure. And I would believe that the way energy is acting is that peak inflation, while it may happen in certain corners, the way energy is acting suggests that we're not quite there yet in terms of when we see a real peak in all the inflation data.
Yeah, absolutely. Well, Todd, this has been super informative, really helpful, a lot of good thoughts and actionable ideas. And I just want to thank you so much for your time, and hopefully we'll talk again soon.
You too, Ross. Thanks a lot.